Finance and sell on Reliance Industries.
Okay, let me now bring on board Vetri Subramaniam, Chief Investment Officer with Religare Mutual Funds. Vetri, good morning. Thank you for joining us. Vetri, last 3 months have been rather nasty for Indian markets. At a time when developed markets are moving from strength to strength, Indian markets are really in some kind of trouble.
In that sense, the Indian markets and I think most of the emerging markets, and even if you look at the so-called BRICS market, it's interesting because the BRICS summit was last week, but all the BRICS market are actually doing fairly poorly, and that reflects increasingly the fact that most of these emerging economies, including India, have run into a series of domestic related issues. In India, it's the issue of high inflation, it's the issue of lack of traction in the investment cycle, and the fact that the current account deficit is under tremendous pressure. So these are all, country-specific factors which I think are affecting economies like India at this point of time. And I think one of the worrying things is that so far, 3 months into this current calendar, we're yet to see any kind of pickup in economic momentum. There have been some reasonably positive data indicators like the PMI, but if we actually distill that and look, deep dive into numbers like automobile sales, port container volumes, you look at freight volumes that the system is carrying, you look at air passenger traffic data, all of that continues to suggest that this economy is still struggling. There isn't really been much sign of a recovery in the quarter that's gone by. And I think when you start to see the earnings for the current quarter come out, it's going to reflect a fairly challenging environment for corporate India. So I think a lot of domestic factors which are holding us back at this point of time.
Okay, just before the bell, let's get you some technical ideas as well. Ashwini, what is your number one trading idea for the day?
I think, Ipca Labs could move forward. It seems that.
Do you think tactically it's now time to put money to use, or do you think we will get better opportunities in the market?
I don't want to look at it in the context of last few days, but if you look at what's happened over the last, quarter, then we have seen quite a few stocks, come down in valuation terms. So while the aggregate market is, only slightly cheaper than long-term averages, we are seeing a fairly large number of companies, albeit most of them are in the cyclical sort of areas related to the investment cycle, but they are trading at fairly reasonable valuations. I guess the risk over here is that you really don't know at which point of time are fortunes of these companies going to look up in terms of their actual, order books and expectations for their revenue growth. So that is a little bit of an unknown at this point of time. But I think from a valuation standpoint, certainly there's a lot which looks reasonable at this point of time. But really the challenge is just that, the economic environment is challenging, and we still don't have a handle on how close or how far we are from some kind of an uptick in the economy and in the investment cycle.
Vetri, but if I look at your declared portfolio, the stocks in the group of names you own, they are expensive stocks. You own banks, you have a decent exposure to IT, which means you are owning quality stocks, but quality stocks are expensive. Are you happy to pay that premium?
I think the approach that we've largely been following at this point of time is that, quality pays. B, we're also quite concerned about the health of corporate balance sheets at this point of time, not just because of the fact that many companies are under severe debt-related issues in terms of stress, but equally from the point of view that it's very important that you invest in companies which have visibility or at least reasonable cash flows to tide them through a fairly difficult environment, because where we want to be invested is in those companies which are best positioned to accelerate as and when the economic environment itself improves. They can't really do much about the tough environment as it exists today, but hopefully they will be better placed to benefit from the upturn. So that's really been the sort of defining philosophy. Having said that, we are unwilling to sort of go into some of the defensive areas of the market where we think valuations are now pretty extreme. Stocks are trading at almost 1 to 2 standard standard deviations above average valuations in some of these so-called defensive non-cyclical areas. So we are concerned about those areas in terms of valuations. But otherwise, I would say our emphasis has really been on buying quality businesses, those which have strong balance sheets, strong underlying cash flow, because we think those are the companies which are best placed to come out of this current challenging environment. And when it comes to valuations, I would also say you can't just look at the classical sort of cheap P multiple stocks or cheap price to book stocks if those companies either don't have any significant cash flow or are not in a position to service their debts. So you need to bring some cash flow related parameters to your valuation methodology and process at this point of time. You can't afford to ignore survivability, if I can call it that, in your investment process.
What about two key macro assumptions for FY14, GDP growth and the CAD, which is the current account deficit? Do you think GDP growth or GDP number has bottomed out and CAD has topped out?
I think as far as GDP growth is concerned, surely we can hope that there's been some sort of bottoming out of the number. I think the fourth quarter of this year will look particularly bad when the actual numbers come out, because typically the fourth quarter the economy sees a bit of a cyclical lift, and some of this has got to do with the Rabi crop, and a lot of this has got to do with government budgets getting spent during the fourth quarter. And I think looking at the fiscal numbers in front of us, it's pretty clear that the government has clamped down on expenditure dramatically to reach its fiscal deficit goals. And given that, I think the fourth quarter might pretty much prove to be a trough with shockingly low numbers for GDP growth. But I don't really see too much of a case for a significant upturn, other than the fact that from the cyclical low there could be some kind of an improvement. But really, more than the GDP numbers, what's important for us is the trajectory of corporate revenue growth, and that is still a very, very weak trend. I'm not able to see a significant turnaround for corporate revenue growth in the near term. So that remains, I think, the more significant challenge for us. To what extent will corporate revenue growth actually accelerate in FY14 as compared to the slowdown that we've seen in 13? As far as the current account deficit is concerned, I think clearly Q4 numbers for current account deficit will be much better than what we saw for Q3. We've already got the trade deficit number for 2 months, and that suggests there's been some sort of sequential improvement. So I think you will see some moderation in the current account deficit. But frankly, even a 5% current account deficit for the full year is a worryingly high number. So I think in that sense, the Indian market, at least in a global context, continues to be at a little bit of a risk, in the sense that if capital inflows were to slow down, India will have a significant problem in meeting that large deficit. And I think eventually there is only one way out of this issue. I mean, clearly there's a lot that needs to be done to incentivize domestic manufacturing, to make sure that domestic manufacturing regains competitiveness, be it manufacturing or services actually. And part of the solution actually lies in allowing the currency to depreciate some more. So I think, from our perspective, we do think some more currency rebalancing and weakening is likely, simply because that remains one of the key elements of any sort of strategy to try and address the large current account imbalance that we are currently facing.
Vetri, since you did raise a concern about corporate revenues, what is it that one can expect from the upcoming earnings? And do you think, again, it's going to be IT which is going to outperform while the rest of the sectors still try and bottom out?
Yeah, I think as far as revenue growth is concerned, if you already look at the previous quarter, revenue growth for corporate India had slowed down into single-digit numbers. Remember, the simple math that all of us used to do at the back of the envelope, which is, if you've got 14-15% nominal GDP growth, you can hope to see corporate revenue growth equal or perhaps even better than. Right now, we are in a situation where corporate revenue growth is actually tracking at half the nominal GDP growth number, and I think Q4, I've seen some early numbers suggest that revenue growth for corporate India will stay at about 7 or 8% year-on-year growth, which is a very weak number. And further, if you actually break down corporate revenue growth, what's very clearly visible is that as you go down the capitalization curve, the smaller the company, the worse its revenue growth is slowing down. And secondly, what's also happening to smaller companies is that they're getting punished even more in terms of margins and in terms of high interest costs. So as you go down the capitalization curve, you find that not only does revenue growth start to taper off, but actually by the time you get to the PBT level, there's a dramatic collapse in profitability because the smaller companies are getting hit more by weak operating margins and also by high interest costs.
Vetri, do you think the biggest risk for this market now is liquidity? Because the fact that Indian markets are underperforming developed markets and the differential is so large, such a large underperformance will not get unnoticed, and it's a matter of time. Foreign institutional investors could turn net sellers here.
I don't think liquidity is really the benchmark of what drives markets. I mean, could you have forecast 12 months ago that with $25 billion of inflows into Indian equities, you would barely be up 7% in local currency terms and, next to nothing in dollar terms? So I don't think liquidity eventually determines the outcomes for markets. I think it's eventually the fundamentals, the corporate earnings that determine the kind of, moves that markets eventually experience over the medium term. And I think this is really our current Achilles heels, which is that the economy is performing extremely poorly, and we're not really seeing significant acceleration in economic growth. So I think eventually the risk to India is that if people start to lose confidence, we've seen a new finance minister who's done a lot over the last 6 months to try and address some of the bottlenecks as related to growth. But at some point of time, all these words need to start converting into actual action on the ground in terms of an improvement in underlying economic momentum. And I think that, to my mind, is the biggest risk, that if at some point we find that this is not converting into actual economic growth, then things will get very, very difficult for the Indian market, because you could be looking at a third year of earnings just about coming in at maybe less than double-digit growth.
Vetri, would urge you to just stay with us. Let's cut across to a press briefing by Mr. C.S. Verma, the Chairman and Managing Director of NMDC. NMDC from today is now part of Nifty 50.
Dispatches are also equally good, and you will bear in mind that in this financial year, which has ended yesterday, 2012-13,